In this video, we will discuss the importance of fundamental analysis for consultants. What is the point of all your hard work if you're not able to make a profit? Fundamental analysis is the study of a company's fundamental financial elements. This form of examination examines a firm's key ratios to determine its financial stability. You will have to do a lot of financial analysis during consulting projects, whether you like it or not. Even if you don't want to be a financial expert, I urge you to study basic analysis. This type of analysis may not be the most exciting aspect of a project, but you must do them to present your findings correctly. Start by conducting some basic examination of the profit and loss statement, income statement, cash flow, and to a lesser extent, the balance sheet at the start. You need to ask these questions. 1. Is the firm growing or shrinking? 2. Is the profit growing alongside revenues? 3. How has the profitability of the firm changed? 4. Is the revenue made up? 5. Which business departments are the most profitable? 6. What costs are the business incurring? What costs are fixed? 7. How much cash is the company generating? 8. What does management do with the cash? 9. What is the structure of the firm from a financial perspective? Let us talk qualitative fundamentals. When analyzing a firm, analysts often consider 4 key aspects. They're all qualitative rather than quantitative. They are the business model. What does the company do? This isn't as simple as it appears. Is the firm's income derived from the sale of white running shoes or football jerseys? Or is it merely relying on royalty and franchise fees? The competitive advantage, long-term success. The ability of an organization to maintain and hold a competitive advantage is critical in determining its success. Powerful competitive advantages are demonstrated by, for example, Nestlé's brand name in the area of sweets and Apple's domination of the smartphone mobile industry. Both of these companies have created an economic moat that keeps competitors at arm's length, allowing them to enjoy the profits and continued growth of a market. When a firm can obtain a competitive edge, shareholders may be rewarded for many years. Management. Is management the most important component for investing in a company? Even the finest business plan may fail if the company's executives do not follow through with it. While meeting and truly evaluating managers, it's difficult for retail investors. You can examine the corporate website and look at the resumes of the top officials and board members. Have they done well in previous employment? Have they been selling or buying a lot of shares recently? Corporate governance. The policies in place within an organization outline the connections and burdens between management, directors, and stakeholders, are referred to as corporate governance. The company bylaws, corporate laws and regulations, and similar policies are all set out in the firm's consultation. You'd want to deal with a firm that is ethical, fair, open, and efficient. Keep an eye on management's attitudes towards shareholders' rights and interests. Check to see how transparent, clear, and straightforward their communications with investors are. What about the quantitative fundamentals? The company's primary source of information is its financial statements fundamental analysis. As the name suggests, it's the study of fundamental factors. To make investment decisions using quantitative information gained from financial statements, fundamental analysts employ quantitative analysis. The income statement, balance sheet, and cash flow statement are the 3 most essential financial reports. The balance sheet. The balance sheet is a company's financial position at a specific point in time. The name of the balance sheet comes from the fact that a firm's financial structure balances as follows. Assets equals liabilities plus shareholders' equity. The resources of a business, such as cash, inventory, machinery, and buildings, are represented by assets. The equation's other side represents the overall value of the financing used to acquire those assets. The method by which a company obtains capital is through debt or equity. Liabilities are debts that must be paid back, whereas equity represents the total value of money owed by the business's shareholders. including retained earnings, which is profit generated in previous years. Income statement. The income statement, on the other hand, looks at a company's performance during a specific period. The income statement is a financial report that shows revenues, costs, and profit generated as a consequence of the company's activities during the reporting period. Cash flow statement. The statement of cash flows is a chronological report of a company's inflows and outflows over time. CFI, cash used for investments in assets, as well as the proceeds from the sale of other firms' equipment or long-term assets. Cash flow from financing, CFF, cash paid or received as a result of the issuance and borrowing of money. Operating cash flow, OCF, a company's cash flow from day-to-day business activities. The cash flow statement is essential since it's difficult for a firm to manipulate its money scenario. Accountants can do a lot to tinker with earnings, but it's tough to falsify money in the bank. Some investors, on the other hand, prefer to use the cash flow statement as a more conservative indicator of a firm's success.